Hey traders, Gavin McMaster here from Options Trading IQ, and today we're looking at the diagonal spread versus the calendar spread. Just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So if you're looking to level up your options trading game, these strategies are game changers. They both leverage time decay and volatility, but they're not identical twins. They've got some key differences that can make or break your trade. So what is a calendar spread? Let's start with calendar spreads. Here's the blueprint. We sell a short-term option and we buy a long-term option at the same strike price. Now, usually those are going to be done at the money to have a neutral calendar spread, but you can also do a bullish or a bearish calendar spread. But most of the time they're a neutral trade and they're going to profit from time decay and changes in implied volatility. They are positive vega, so they tend to do better when volatility increases. We also have to watch the skew as well. They're perfect for neutral markets, so they do well when the stock price stays stable and when implied volatility is expected to increase. What is a diagonal spread? So diagonal spreads are very similar, but they add a little bit of a twist. So we sell a short-term option, but we buy a long-term option with a different strike price. This introduces a directional bias to your trade. Let's have a look at some examples. So firstly, let's look at a calendar spread. We're going to use NVIDIA as an example. We'll throw this into Risk Navigator. Now, as I said, most of the time they're going to be neutral trades. So we'd look for the at the money strike. That's going to be our short-term option. We're going to sell that one for about 510. We're going to go out to January, choose the same strike price, and we're going to buy that one for 870. So we'll just use the one, actually we'll use two contracts, and we'll pick our expiration date and we'll add a T+0 line as well. So there's our trade, there's our calendar spread, has this triangle shaped profit zone, pretty much delta neutral. The delta that we're short is pretty much offsetting the delta that we're long. So delta neutral, positive vega and positive theta. So positive vega means it's going to do well if implied volatility rises. But we also want to watch out because we're trading different expiration dates, we're exposed to a little bit of skew. Now, in this case, the option that we're buying has higher volatility than the one we're selling. Ideally, we'd prefer that to be the other way around. So for that reason, calendar spreads great when the market is in backwardation, when short-term volatility is higher than longer-term volatility, but that's okay. We could still potentially have a profitable trade in this case. Now, the other thing we could do, as I mentioned, we could do this as either a bullish or a bearish trade. Just going to change this. So we've got the stock price at the bottom here. If we think NVIDIA is going to rally up to say 145, we could place our calendar spread up at 145, and that would be what's called a bullish calendar. Or if we thought it was going to drop down to 130, say, or 132.5, we could place our calendar there, and that would be a bearish calendar. Again, the majority of the time people are going to do these as neutral trades. In terms of trade management, I like to set adjustment points right around these break-even points. So about 132 on the downside and about 146 on the upside. And when I adjust, I either turn it into a double calendar or I actually turn it into a diagonal, which we're going to look at in a second. So that's calendar spread. Let's take a look at a diagonal spread, which is going to be slightly different. I'm going to structure it with slight bullish delta. So I'm going to use puts in this case. So again, we're going to sell the at the money put, the 138 put. We're going to go out to January and we're actually going to buy a lower strike put. And you'll see this gives it a bit of positive delta. So again, we're selling our short-term at the money put and we're buying a long-term out of the money put. I'm going to remove these ones. And you can see now we've got a directional bias to the trade. We've got more risk on the downside. Change that to NVIDIA again and zoom back in. We've got a little bit more risk on the downside, 1300 now, but we've got less risk on the upside. So we've got very positive delta 25, compared to the more or less neutral delta that we had on the calendar spread. Our positive vega is about the same. I think previously we had 14, now we've got positive 12, and our theta more or less the same. I think it was 8, now we've got 9. So you can see very, very similar trade, just a slight difference. We've basically lifted the right side of the graph and we've dropped the left side of the graph. So we've got more risk on the downside and more of a directional component to the trade. In terms of trade management for a diagonal like this, again, I want to set an alert around that break-even price, and that's where I'm going to make a decision to either hedge, adjust, or close. On the upside, I don't worry too much. As you can see, the trade's going to do quite well on the upside. Once that T+0 line starts to drop, again, that break-even price up about 155. That's probably where I'd look to close out if Nvidia's continuing to rally up past that level. Probably fairly unlikely that it gets there in this sort of time frame of about 17, 18 days. But overall, positive delta, positive vega, slightly different setup to the calendar. Now, one thing I like to do with calendar spreads and diagonals is utilize earnings and the volatility skew that we get around those earnings dates. So here we're looking at Broadcom, which reports earnings in a couple of weeks. And you can see here's our earnings date here. And the first expiration after earnings, we've got very high volatility. So we can use that to our advantage when we're looking at calendar spreads and diagonals, because we can sell the short-term option with high volatility and we can buy the longer-term option with lower volatility. So let's look at how that would be structured. So we'll go back into Risk Navigator. This time we're using Broadcom. Earnings are on December 12th. So we want to pick the first expiration after earnings, which is going to have the highest volatility. And we're selling that option. See there, 55% IV. And we're going to use a diagonal as our example. We go out to January and we buy something down there at 160. Let's have a look at how this one looks. So we sell the short-term option. We buy the longer-term option. Change the expiration date and just reset that T+0 line. Now you can see a bit better looking trade in terms of our risk to reward. We've got less risk than the previous example and still a very nice profit zone here. Basically because we're taking advantage of that vol skew. We're selling the high vol, buying the low vol, and we've got basically no risk on the upside. Because of the option that we're buying is lower priced than the one that we're selling, we actually get a slight credit. That means if the stock rallies, both the puts can expire worthless, and it doesn't matter. Our profit is the slight credit that we get at the start of the trade. Still got similar risks on the downside. We still want to set an alert point down on the downside somewhere, but that's a very, very nice setup and a great way to trade earnings and take advantage of that volatility skew. Let's have a look at what a calendar spread would look like. So the diagonal's obviously got that directional component with the bullish delta. Now we haven't got a 167.50 strike for January, so I might have to just change that to a 166 strike. I'll use puts just to keep it consistent as well. And let's see what our calendar spread would look like. We'll sell that one. So there's our calendar spread. We're selling the 166, buying the 166 for Jan. I've used the wrong expiration date. Sorry about that. It was December 13th. See, now it's not really going to work because we haven't got consistent strikes. All right, let's structure it with a little bit of bullish delta. We'll go with the 170 strike. And we'll get rid of those ones. Sorry about that. All right, so still more or less neutral. And look at that compared to the NVIDIA example. Not risking a whole lot in terms of the max loss on the downside and the upside. And we've got a very nice profit potential in comparison to the capital at risk. Let's just reset that T+0 as well. Looks a little better. Still got our positive vega, really high theta, much higher than the NVIDIA example. And again, we're taking advantage of that vol skew by selling the high vol around earnings and buying the low vol after or a few weeks after earnings. Now, the main risk obviously is if we hold through earnings, the stock could have a big move in either direction. So that is the risk if you're going to do this type of trade over earnings. So just keep that in mind. It does come with high risk of the stock making a big move, which could see it outside the profit zone. So as we looked at, some of the key differences are the strike prices. The calendar spread uses the same strikes. The diagonal spread uses different strikes. They also have a different directional outlook. Most of the time, calendar spreads are going to be a neutral trade, whereas diagonal spreads are going to have a directional component. We looked at a bullish example. You can also do them with a bearish bias. Most common is the bullish bias. And there's some difference in profit potential. So calendar spreads profit mainly from time decay and implied volatility changes. Diagonal spreads profit from time decay, volatility changes, and potential favorable price movement as well. So when should you use each strategy? Well, you want to choose the calendar spread if you expect minimal price movement, you want to profit from time decay, and you prefer lower risk trades. Choose the diagonal spread if you anticipate a modest price movement. So in our example that we looked at, slight bullish delta. So we're looking for a slight positive move in the stock. You would use it if you want time decay and a directional potential to the trade. And you would only use it if you're comfortable with slightly more complexity, the diagonal spread, as you might have seen, a little bit more complex, a little bit more moving parts than a calendar spread, which is probably a bit more of a traditional trade, a little bit easier to understand. So in conclusion, always remember to focus on risk management, especially in volatile markets, and adjust your trades as needed. Always have a plan what you're going to do for each trade before you get into the trade, and try to have that written down so you know exactly what to do depending on whether the stock goes up or down or stays flat. Make sure to check out all the resources in the description below. Reach out anytime with questions and have a great day.